This is Justin Pulitzer. This is my weekend review video for Sunday, August 30th, 2015. I'm going to start off a little bit differently than usual, and I'm going to start off in the BRIC countries, Brazil, Russia, India, and China. And I want to show you how they're faring in the rest of the world, so to speak. And these were considered the global growth engines up until fairly recently, how they're faring in relation to us. And I think that this is going to explain a lot of what's happening in the current markets. So as you can see with regard to Brazil, they have a communist government, communist socialists under Ms. Rousseff, who was a former basic guerrilla. So they have been engaged in socialist policies for a while, but we know that they're very levered to the growth of the world. They're a exporting of commodities country, and you can see with the decimation that we have had in commodities, and I will show that next, that they are now currently trading below the financial crisis lows. So that's Brazil. Russia, we all know Vladimir Putin has been engaged in trying to put back together the old Soviet Union, and that's probably what's made Russia a little bit less investable, but as you can see, not quite at the financial crisis lows, but getting in a series of lower highs and lower lows, getting close. India has been faring a little bit better, but you can see also making lower highs, also below this consolidation range up here, which is a still lower high. So they are showing some weakness, not quite as much as Brazil and Russia, but they are definitely coming down. And China, which is the one we've been discussing endlessly the last few weeks, particularly in the news media. You can see the Chinese made a run. They didn't quite get up to their old all-time highs, but have been in a bit of an epic fall below, back now getting into some relative support. I would say that I do have some alerts set. There is there was a partial violation of this trend, and I would say that as we start coming back into some of these lower levels, that there might be some areas to look to start to buy China. I believe that that's probably going to be a counter trend call, considering the relative bearness by the media. But if we did start getting down into these lower levels, we didn't quite get the 61.8, but I would say somewhere between the 32s and the 28s, I'd be looking to sell some out of the money puts, and maybe even buying some shares of this into like an IRA account. There you could kind of just sit on it for a while. We all know that the commodities, particularly oil, have been trading down, not quite at the financial crisis low, but we are getting dangerously close to those levels here. There had been an old breakout from way back in the day. I believe that was back in 2000 or so, but we are below trend. We have been going down here for weeks after a bounce to a lower high, and we are now starting to break and first start peaking above the downtrend line of this recent leg for quite some time. This low here on this weekly bar might be considered a good low, and maybe oil is first starting to really show signs of putting in a bottom, at least a tradable one for some time. I do think that this is showing a lot of weakness. A lot of that has been thanks to relative strength in the US dollar. You can see it has had a very large ascent in the last year or so. And we have just been kind of consolidating some of those gains for a while. Let's go into a little bit more modern times here. So you can see the rise in the dollar has had a very adverse relationship with global markets. The Chinese are now kind of trying to devaluate to kind of grow their way out of it. We are going to experience a lot of issues with regard to international companies and their earnings. With regard to, they've been complaining for a while, but there has been some growth within the United States that has kind of offset some of this. But now as growth is slowing globally and possibly domestically, we are kind of consolidating these gains, and if there is a move back up in the dollar to re-challenge these highs and maybe still beyond, that could put a pinch further on commodities, further on global growth, and further on U.S. domestic stocks, as they rely increasingly so on the world for growth. You can see that as it became evident that Asia and the rest of the world and our U.S. markets were weakening, the dollar had a bit of a head and shoulders. You can see the left shoulder here. I wouldn't say necessarily a head and shoulders, but it kind of has that pattern breakdown, and now we've kind of had a check back to that breakdown level. Also, all of the major moving averages are here, and this is going to be kind of put up or shut up time in the 96s, whether or not the dollar is going to probably resume its move down, or if it's going to test these highs. I would say if it does test these highs, it becomes increasingly likely that that type of a scenario does happen. I've been talking about TLT for a while. I said I thought we would fill this gap. We broke the channel high. We got up here. We've since had a bit of a reversal pattern lower, and we are now currently below the 2009 crash peak highs and lows. We are below there. I would say that if interest rates start rising and this TLT starts coming down as there's increasing fear of Fed rate hikes, that might play a little bit of havoc on the U.S. stock market, at least in the short term. Here, with the fear was recession. Now here is starting to be the fact that the Fed may start raising rates regardless of growth. These Fed governors come out daily on TV. Friday, that Stanley Fischer, I had heard, he's the vice chair, I heard him speak. He did an interview with CNBC, and he wasn't willing to fully take the rate hike off of the table, the one that we've all been kind of dreading for September. However, on the previous day, I believe it was Thursday, Fed Governor Dudley from the New York Fed kind of assuaged markets' fears, saying that he thought it was less compelling to raise rates. My opinion, and I've been discussing this, and this is, believe it or not, still in the lower for longer camp, considering that this is considered amazingly low interest rates, and they've been, for a while, been trading considerably lower. I believe that the Fed is going to be on hold in September. We did have a GDP number that was raised for the second quarter considerably. I think it was from 2.3% to 3.7%. I have to check. That is a pretty big jump, but I believe a lot of that was demand that was pushed back from the slow first quarter, which was only 0.6%. That's a really low GDP. I would think that the Fed, if I were on the governing body, given the recent market weakness and weakness overseas, I would want to play wait and see. The Fed has been warned two times now by, I always joke around, I say Yellen's BFF Christine Lagarde, as well as the World Bank, to keep rates on hold for a while as the emerging market world is really under havoc, and raised interest rates would hurt them severely, as well as, I believe, slow the kind of stall speed sputtering U.S. economy. We all know, I've discussed for weeks and weeks, that durable goods orders have been, outside of aircraft, a little bit weak. There was a little bit of a jump in them in the recent data. I have to go in and take a look at what that was attributed to. My guess is it again was attributed to kind of the Boeing effect, so to speak. We all know that the labor participation rate has been very low, meaning the percentage of U.S. Americans who are working is the lowest in 37 years. Not exactly comforting, considering the headline number says that we are basically at maximum employment. If you take a look, the markets here are starting to show some weakness that was shown by the VIX. We are now, the volatility has really increased. The Fed has been really trying to, I guess, and they've been fairly successful to lower the volatility in the world, but we did put in a fairly solid low here, and the volatility has spiked into the 50s. You can see that the highest we've seen up until recent years has been 25. And I always say that 25 is like the height of kind of, quote, healthy panic. Anything above there puts crash risk into effect. And here you can see we had closed above there last Friday. We all know we had a bit of a flash crash on Monday with a lock limit open down with regard to the S&P futures. And we have rebounded a bit, but you can see volatility is still closed relatively high. We are still above the 25, and that still puts crash risk on the table, in my opinion. This weakness kind of started out in the Dow Jones. We had a pretty big pullback here. I want to see if I can show, let's see if we go to a 3-year chart maybe. You can see we didn't quite get to the 2007 breakout. That was the old high in 2007, but you can see we have broken a one uptrend. We came down fairly low. We broke these lows. We got not quite down to these lows, but into these. And we did have a bit of a rally back. We have gotten a decent portion of the breakdown back, although you can see we are just kind of dipping our toe into the breakdown, a 50% fib. We just got shy of there. The 61.8 you can see would be a gap fill, kind of a retest of where this range breakdown would be. So I would say between here and here is going to be really where the rubber meets the road. I did have a quick glance at the S&P futures and seen they were down about 20 points, which probably isn't encouraging for further rally. We'll have to see how that plays out. The futures may get themselves in a tizzy, and that may not work out till the Monday open. But I will show you in S&P in more certain terms about what really needs to hold and where things can go, either to the upside and to the downside. IWM, which is sort of the proxy that a lot of traders use for risk on, risk off. You can see we are also a similar scenario. We have been breaking down. This has been even worse for weeks. We came back down. We got past where the measured move would be from sort of the last decline. We didn't quite get to those lows, but we are bouncing. We are testing the channel, the backside of the down channel here, getting into some volume distribution into reference lows here. And we are not even close to the 50% fib from that move. We are just shy of the 38.2, which is, if we stop there, fairly weak for IWM and maybe for risk appetite. Anything below this 120.58 and for sure the 117.37 is showing relative weakness. And you can see where these old tops here, where the breakout really took place, they were tested on previous pullbacks. We tried to go higher. Now we were retesting here, a failed attempt, and then a more severe liquidation break than we've seen for a while. I would say on a rally back up somewhere into these fibs here, particularly the 61.8. I don't know if we're going to even be able to get that strong, but will be for sure a good right or right out short scenario. I do believe that anything below here also would set up for some type of a short scenario, maybe to retest back down closer to these lows. Let's do SPY, and then we'll get into the Qs. You can take a look where this has sort of been a large consolidation for the last better part of a year, about 8 months or so. And this was the old top here, the 2109. It developed into a more severe correction. This is the biggest correction we've had in a while up until recently, and this wound up holding and we went up higher. It held to the channel low, basically to the tick. And I had been discussing last week before this sort of meltdown that this low here, which would coincide with the channel low, as you can see, and also this old high here, I thought would be an interesting support point around this 2190 area. Let's just call it 202. And we wound up breaking, here. It knifed through it, and then Monday we had the follow through. This Friday was the break. Then Monday was the follow through, and you can see we got really close to these reference levels. As we know, we're in a responsive market. We got the subsequent rally back up. However, if you take a Fibonacci from this level here, and it's not on the chart, I'm just using the full high. That this is basically the 61.8 of the breakdown, and we filled this gap. Like I said, we got close to these reference lows, and the question now is going to be how far and how high does this bounce go? We got about to the 50%. SPY has been a little bit stronger than the other indices. The 61.8 you can see would be a test to sort of where that real breakdown took place. as we did get into these 97s. If we start losing the 197.86, and it looks like we may with the open, with the futures being weak, then I would say that maybe the bounce has sort of run its course and we're going to come back down and retest these lows. You know, I was talking about in Periscope this week on my two broadcasts. I did a one on Monday. I will have the link for that in the description below, as well as one on Friday, that I said that I would, if that this area here, that I thought we would rally back up into possibly those lows. I've also heard some of the talking heads concur with me about the 204s. This was really this breakdown, the more severe breakdown. It wouldn't shock me if we do wind up retesting the backside of the old up channel, which could coincide roughly with that 204. That to me would set up for a great right or right out type of a short situation, particularly if we rally up sharply into there. However, we might not even get that high. It could be that we just rally somewhere between here, the 50% fib, which we got to, and the 61.8, which is those 201.90s, like I had mentioned, and then roll over again. If that happens, you know, the market could get quite squirrely. You know, this is really only leg one of a potential three-wave move lower. It wouldn't be inconceivable, and I've talked about this on previous broadcasts, to see a test of the primary trend down near here, near the 167s, where we currently would be that is the trend low. I want to try and show you guys this. Let's do a monthly, maybe 10 years, or a weekly. Let's do a weekly. You can see this is the 2009 financial crash low. This was basically the double top of the 2007 and the 2000 peaks. We broke out of there. We kind of had a little bit of a retest, but we have been rallying since, and we've never really retested that. Also, we have now, like I said, broken the 2011 channel that has not been violated to the downside here. So that leaves a lot of runway for a test of primary trend, which has not been tested in some number of years, and that could potentially happen. Maybe we do wind up coming down and retesting there. You can see, as bad as, you know, people have been talking about this sort of snap being, we haven't even retested a 38.2% Fibonacci retracement, nonetheless the 50 and the 61.8. So I am very cautious this week with regard to where we could roll over to. And I would say that if we do wind up rallying back up into these areas, these will set up for some good right or right out shorts. So the market really has got to prove itself. It is. I will say this: the one thing that the bulls do have going for it is that this move was very sharp and very fast, and it's possible that this is just a larger liquidation break leading up to the blow off top. You know, where we came down here, washed out all of the weak, you know, hands, ran a lot of stops, and then we're just going to, you know, kind of have that launch and blow off where the market just explodes higher. I'm not so sure if that's going to happen. This is starting to look like the 2007 top, where it was just this consolidation grind. There was the break, we had the, you know, the counter move, and then the subsequent rollover. So it's a little bit early to tell, but I am really, really guarded with regard to SPY. Let's take a look at NASDAQ. That also has had a consolidation. That actually got a test of one of the larger trend lines on a little bit of a flash crashy action, and is now kind of back up to sort of like where the real breakdown took place. There's been a lot of weakness in some of the big NASDAQ names. I'll talk to you about Apple. They do have a iPhone launch coming up soon, so there could be some kind of green shoots here with regard to Apple. It did break kind of the downtrend here, but it did stop basically right on the 20-day moving average. All of these averages here now, the 100-day, the 50-day, the 20-day are all downward sloping, and you can see the 200 hasn't quite rolled over yet, but it is flattening out. We did break some key levels here, the 109, which was the gap fill here. The flash crash sort of got us back down below where we kind of needed to be. I had been saying that I think 85s were possible on Apple. People thought I was crazy. We got 92s. We didn't quite get the 85s. I'm kind of sorry that didn't happen. That would have been an amazing buy. But we did get to the 50% fib, and now we rallied back up So we're going to have to look to Apple for its leadership. If we start losing this sort of 115, we didn't even get to the 115s, which are sort of the old a really important old low. But if we start losing this 109, 110, 109 again, I would say that the market is in some more severe trouble than people might realize. If we do keep rallying up, it would not shock me to see it retest the 119s. That would be the move in Apple. Amazon kind of blew its brains out. It had this big gap and crap, and it just consolidated and then broke down, filled the gap, and then some. We didn't get the test of the primary trend from this gap here, this sort of long-standing trend line, but we did get a rally back up, and we are now still sitting at the downtrend line, sort of right where the breakdown took place. Look at this. Look where these lows were. Look where Amazon kind of topped out. It could potentially roll back over. It could potentially roll back over now, or it could punch through. I would say that given the market weakness, the bulls have to prove themselves. The stock could really roll back over again. AMBA, also another one that was, and it would help if I could type out ticker symbols, was another kind of proxy for the bull market. Made a bit of a double top, had the breakdown here. We got the 50% fib. Got back down into sort of where the big the big run took off, and now rallied back up, and look where we stopped, really just where the breakdown took place. If we are entering a bear market, the theory would be here now that we roll back over again. If the bulls are going to really prove themselves, they're going to have to take it back up to the sort of the downtrend, and then kind of poke it up. But this is looking pretty bearish. I mean, look where this big volume distribution is, and look where price stopped. And we're sort of mid-channel here. There's a lot to prove. The bulls had a had a big trauma. They really have to prove themselves now. Facebook, one I've been bullish on for a long time, was a victim itself of a flash crash. Look where we came back down to, all the way down to these lows, 72s, which is on a longer term time frame, a larger support. But if you kind of nix this out, if you take out this flash crash, it held basically, even on the Tuesday pullback, it held the breakout here of the 82.95s, and then rallied back up, and it filled the gap and stopped around the 50-day moving average. So this is sort of really, again, also has to prove itself. What are we going to do with this? Are we going to roll back over and retest? Or are we going to, make a move back higher? I hate to have to say, but the market really has to prove itself here. These stocks have had some pretty traumatic moves, and it is not looking all that pretty for all of them. Twitter, look at this. It broke down below the old reference lows, came back up to retest, now made some new lows, and now is kind of chugging. Whether or not this is a good, clean excess low, I don't know if we're going to know. Their earnings aren't coming up for quite some time, and I suspect that it could rally back up to fill maybe into this gap, but I don't know how much more it's going to be able to do if there is some strength. Maybe there's some takeover rumors, and it gets a bit of a bid under it. Netflix. I actually played this one short here and made some bank here. I had shorted it in the 105s, and I covered in the 193s a little bit early, although this really was like a blink. And now it has rallied back up. But if you X out this day, take a look at what this pattern is starting to look at. A left shoulder, a head, and maybe here a right shoulder, and it could roll over again. These stocks have had a lot of gains. This one is barely even down if you factor in like where things have gone in the market. Excuse me. And maybe there is a rollover here. If we do wind up taking out this high, and this is like a kind of tries to have a false breakdown, this could considerably be significantly higher, because a failed head and shoulders top usually does lead to some real major excess, and this could have some kind of explosive move higher. But as far as I'm concerned here, Netflix, how could the news get any more bullish for Netflix? Everyone is in love with the stock here. Everyone has been a winner for a long time. This story has never been greater. I'm just saying be a little bit cautious, and if you're long, and you've been riding this for a while, maybe book a little bit of profits. Priceline, I said this was also sort of a victim of its own success, rallied ahead of the time, gapped, and then wound up selling off, did get the move back down basically to the 61, just shy of the 61.8 and the primary trend here from these lows, and then has rallied back up. But if you take a look, if you draw the trend line from here to here, it is just sort of just poking its head above it. This was getting to be unsustainably steep. You know, it still has a 20-day moving average, and these old reference highs up here around the 1280.97. Let's draw that in. 1280.97. A lot of you know my charts had kind of, I had a bit of a meltdown a couple of days ago, and I had to redo all these charts, a lot of them by from scratch, and it's just been a bit of a nightmare. So bear with me a little bit if my charts aren't what they always are. But I do want to show you one more thing here that could be a little bit unnerving. You have this. We're gonna draw it. Maybe I'll do it from here, like this, and this could be a issue. Back here, back up to these reference highs. This could be also a head and shoulders top. It's not as clearly defined as the other one that I had shown with regard to Netflix, but this could be a rollover situation. Things are getting a little bit squirrely in the market. I think I'm going to end on Tesla. That's always a favorite that I end on, and I've ended on in the past. And you can see Tesla also is coming into a downtrend line here. It's slightly below it. We had a bit of a weak close underneath the line just a bit. We're below the 50-day moving average. They had done look where we pulled back to, though. We looked a little bit below the primary trend. We kind of got into this gap here. We didn't quite 100% fill it. Would have been nice if we got all the way back down to these reference lows, the 100% retracement, and also the 61.8. But we did get back down to the 195s. I had been saying I thought that the 202s to 205s here would support. We kind of basically did. If you look where the body of this picked up here, it was around those 202, 203s, and then we rallied back up. So the key for Tesla is to hold the 242, which was the Elon Musk buy-in for the secondary that they did. Anything above 242 to me is bullish. Anything below becomes a little bit more bearish. And I think that's where we're going to leave off. A lot of this is going to depend, I believe, on the overall market strength this week, and to see where the correlations of stocks, particularly when they move down, move closer and closer to 1, meaning if the market is down a lot, your stock will probably be down a lot. If the market is up, your stock should be up, but it might be a little less certain. I always say that in bull markets, people can, kind of have this it's sort of an actualizer market. It becomes, business models become important, and new product cycles, and the kind of the I wouldn't say the silliness, but the sort of individualizing yourself, and stocks sort of take on personalities of their own. But when things go badly, all stocks sort of trade as an asset class because there's forced liquidation from margin calls and stuff. And I believe a lot of the weakness we saw in the market is as a result of that. Do keep in mind the backdrop I've been saying for weeks and weeks is that the market on close orders, which are big institutions putting in sell orders at the close, has been favoring the sell side for months and months. That's been this big distribution. This was finally the break. We're kind of having the retest back. So if you've been overly long and you're getting margin calls or maintenance calls in your account, you probably want to look to sort of take some of your position size off as we bounce into sort of where the breakdown was. There's always the breakdown and the retest, and this is sort of becoming the retest. Anyhow, if you're not following me, my Twitter handle is @JustinPulitzer. If you're not subscribed to the station, just below there is a subscribe link. Be sure to hit that, and the thumbs up button would be nice. Let me know if you liked the video. Anyhow, let's have a good rest of our Sunday night and a good trading week. I'll be doing some Periscope and updating some levels as the week goes on. If we do get up into here, or if we fail and roll back over, I will discuss some more downside levels to be looking at. Anyhow, let's have a good week, and cheers.